Let's be honest. Most Americans don't lose money in the stock market because they chose bad investments. They lose money because they interact with their investments too often. And before that sounds extreme, think about how many times an investing app is opened without any real plan, not to rebalance, not to adjust strategy, just to look. That behavior feels harmless, responsible even, but it isn't accidental, it's designed. In the United States, investing is framed as activity, checking, adjusting, reacting. Action feels productive, silence feels irresponsible. So when an investing app feels fast, responsive, and alive, it feels correct, not because it builds wealth, but because it matches a culture that rewards constant engagement. The question isn't why people overreact. The question is why the system keeps them watching. Open almost any American investing app. The first thing it shows is movement, daily changes, percentages shifting in red and green. That information isn't neutral, it directs attention. Long-term wealth grows slowly, but slow visuals don't encourage frequent return. So the interface emphasizes what changes fast, even when those changes matter least. This isn't financial advice, it's interface psychology. Imagine a market opening. An app is opened casually. A stock is down less than 2%. No decision was planned, but discomfort appears. The screen refreshes, more data appears. A headline enters the picture. A decision follows that wasn't intended earlier that day, not because the market demanded it, but because attention was redirected. This is where design stops being informative and starts being behavioral. There's another pattern that's even quieter. Portfolio checks at night. Not to trade, not to adjust strategy, to confirm that everything is still okay. Green brings relief. Red creates pressure. Over time, investing stops feeling like planning and starts feeling like supervision, like checking something important before sleeping. The interface didn't create the emotion, it normalized it. In other markets, investing tools feel restrained. In the United States, they feel urgent because American finance is optimized for participation, more opens, more interactions, more moments of attention. An investor who checks daily is more valuable to the system than one who checks yearly, even if the second investor performs better. The platform doesn't operate on long-term timelines, it operates on visibility. Here's the consequence. Long-term intentions fade, short-term signals dominate. Most people remember what their app showed them this morning more clearly than what they invested in years ago, not because markets changed, but because attention was reassigned. Once this pattern becomes familiar, the outcome becomes predictable. This doesn't mean investing apps are malicious, it means they're optimized for engagement, for relevance, for action. Wealth is built differently. It benefits from distance from constant updates, distance from emotional signals, distance from unnecessary interaction. The conflict isn't personal, it's structural. Before opening an investing app, one question matters more than the numbers on the screen. Is this action building wealth or simply satisfying attention? The answer usually explains the result.